This quote from your work, I've read this 3, 4, 5 times now. Can I just share this with you? If you're just waking up, just listen to this. Monthly median value of savings and checking balances are more than 40% higher than 2019 for all income levels. You're looking across 69 million consumer and small business clients. That's not a typo, is it?
No,
40% up?
It's not a typo. And we've been working at the Bank of America Institute for 2 years, looking at and leveraging the bank data to tell us real time what's happening. And this has been the statistic that has shocked me, but it's what we're seeing for the last 2 years. Everyone thought we were going to run out of money. The consumer was going to run out of money. And this year, the consumer has been very stable, keeping their checking and their savings deposits 40% higher than they were before the pandemic.
So now, that's not coming down, that's just remained stable.
It's coming down by 0.1%, but it's been around 40% higher for really the last 6+ months.
How much of a cushion is that for the US economy at a time where we're talking about rising delinquencies, maybe some credit card issues as well? How much of a cushion is that?
I think the cushion isn't necessarily on the savings side. The cushion has been in the labor market, particularly for the lower and the middle income consumer. So last month we saw, what we look at is the actual money coming into the accounts. So the after-tax wages and income getting deposited into the accounts. And we saw for lower income consumers that tick back up of 3.4% last month, which is the highest level it's been in almost a year. So when you see the labor market remaining strong, there isn't as much of the need to draw down onto that savings. Now, you mentioned before, you were talking about the difference between the higher income consumer and the lower income consumer. The big difference there, the higher income consumer is generally also participating in the markets, right? So even though their wage growth has actually been negative for quite some time, they've got the cushion of equity market performance.
Some people would say that sounds great. It sounds like everything is hunky-dory, but there's weakness under the surface, and just wait, hold on one second, and it comes in the form of leverage, it comes in the form of credit, and that we've seen credit card outstandings go up so much. We've seen buy now, pay later cushion, particularly younger households and their ability to spend. What do you say to that?
Well, I think, have we seen delinquencies move up? Yes, but not to an area that we're really particularly concerned about. The other thing that we look at is what's the ratio of spending that people are putting on their credit card relative to their debit card? That would be an indication that people don't. Those ratios are really essentially the same. But you talked about buy now, pay later, and buy now, pay later I think is really interesting to consider. When buy now, pay later first came out, it really did boost retail spending for the people who were using it. Really up 40+% relative to non-buy now, pay later users. But what's interesting is what's the population that's really using buy now, pay later? When we looked at our data last month, just under 9% of our customers made a payment to a buy now, pay later. So they had used it, just under 9%. That number is growing relative to last year, but at half the pace that it was. So is buy now, pay later really going to be the boost if less than 10% of people are using it?
Nothing you're saying right now speaks to recession or weakness. Nothing you're saying right now speaks to anything that's close to a slowdown, a material slowdown in spending. Is there any historic corollary to this moment suddenly turning south really quickly with a labor market that still looks really good and people having that cushion?
We keep looking for that. We keep searching, and we're just not seeing it. Now, what I will say is, if we were talking a year ago, I would have said resilient, 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 resilient. I mean, there was nothing. What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable. They're softer and they're staying there, just like the deposit balances. They're stabilized at about 40% higher. Again, if we were having this conversation a year ago, lower income households' deposits were up 200%. So they've come down from that peak. They've spent, the stimulus, but they're stabilizing at that up 40%. Labor income continuing to increase.
Do you think there's space to lever up? Do you think there is space to lever up for the consumer? Because every time we see any signs of that, people start to get worried, like this is it, this is a tipping point. I just wonder, given everything you've said, it just sounds like we have space to do that in this economy.
I think everyone is looking for the consumer to roll over, and the advantage we have at the Institute is we're looking at the data as it's happening, and we're not seeing them roll over yet.
What about the small business clients as well? Is there a difference there?
Small businesses, you would think there might be. Small businesses are actually, again, they've been very resilient. They've been behaving very much like the consumer. I do think that they're softer. They're a little bit softer than they had been, but again, not rolling over. Small business was such an engine of growth through the pandemic and continues to be.
Is it across the board, or are there differences from sector to sector at the moment?
That is a great question, and I need to come back to you on that one.
I appreciate that. We can revisit the topic another time. I'm just trying to figure it out, because when we talk about how restrictive we are, a lot of people might point to large companies that can come to credit markets, issue tons of debt. We've seen all the supply through the start of 2024 taken down quite nicely. I just wonder if small businesses are having the same experience borrowing as their larger cohorts, their larger peers.
I think the small businesses are really behaving very much like the consumer is, and they're doing okay, and they're a great engine of growth. So we continue to love doing business with small business, but yeah, they're doing okay.
So just taking a step back as we reset, as Jay Powell wakes up in Washington, D.C. and prepares for his two-day meeting, what some of the fundamental structural shifts have been in the economy to allow people to have more cash in their balance, in their balances. And I wonder how much the housing market has to do with this. The fact that a lot of people used to save money that they would then put as a down payment to a house. That was the massive purchase. Does the fact that that's no longer as much on the table because there isn't the supply and it is so difficult to get into this market, is that one of the reasons why cash balances maybe are so persistently high when in the past they would be put towards something?
Well, I don't know that that's necessarily true, because I think, yes, you have people who aren't necessarily getting into the housing market right now because rates are what they are. They don't have, but at the same time, if you were in a house, you're not necessarily moving either. And I think if you look at rental prices, we have seen more recently rental prices in terms of what people are actually paying. So not necessarily what is being advertised as going up each month after month. But remember, if you're in a rental apartment, you're in there for the year. The rental prices seem to be okay. Now, are they investing, to your point, in the purchasing house? No, but where are they putting that money that they do have? They're putting it into the market. And remember what we talked about earlier with the highest income Americans.
Which brings us sort of full circle, and this is something that we were talking about in the past couple of weeks, how there's been this structural shift with retail investors accounting for a greater proportion of the overall investing base. How much is that a structural shift that materially changes the business of banking in some ways? Because all of a sudden, people have money, and instead of putting it into a house, they're putting it into the market, and they're looking for wealth managers.
Yeah. Well, that's a really good question. It's one we haven't looked at, and frankly, one we probably should consider looking at across the board from what people are doing in their consumer bank versus what they're doing and how they're investing.
So looking forward, what are you watching for to know whether this cycle truly is shifting or rolling over in any material way?
I focus on the labor market. I think the labor market is the driver of spending. The labor market is the driver of how people are able to engage. And if we continue to have a strong labor market, particularly on the lower end, I think we're going to continue to have a consumer that can engage.